The Federal Reserve held its benchmark interest rate at 3.50 to 3.75% on the 18th of March. The vote was 11 to 1. 3 weeks later, the minutes were released. Inside those minutes, a growing number of officials pushed to keep rate increases on the table, an escalation from the January meeting, where the appetite for tighter policy was narrower. The federal funds rate has not moved since January. The next meeting is the 28th of April. Futures markets, as tracked by CME FedWatch, are pricing in roughly a 98% probability that the rate will not move then either. The median projection from the March Summary of Economic Projections still points to one cut this year, but several officials pushed the expected timing of that cut further into the future, and some wanted the post-meeting statement to explicitly leave the door open for an increase. That is the institutional reality. What follows is what it means in three very specific places where American households actually feel: the federal funds rate, the savings account, the credit card statement, and the mortgage. Think of the federal funds rate as a tide. When the tide is high, everything floats. Your savings account earns more, but your credit card charges more, your mortgage costs more. The money moves in both directions at once. The question is not whether the tide is high or low. The question is which of your boats is bigger. April 2026. The FDIC national average savings rate stands at 0.39%. According to the Federal Deposit Insurance Corporation's March 2026 data, it has not changed since December 2025. On a balance of $10,000, that is $39 a year. At the same time, the top-yielding high-yield savings accounts are paying between 4.00 and 4.60% AP. According to Investopedia and Bankrate surveys as of mid-April 2026, on the same $10,000, that is $400 to $460 a year, the gap between the national average and the top available rate is roughly 4 percentage points. According to FDIC data, the national average savings rate has remained below 0.60% throughout the entire current rate cycle, even as the federal funds rate climbed from near zero to above 5%, and then settled at 3.50 to 3.75%. The average rate at the largest commercial bank sits even lower than the national average. The Federal Reserve raised the floor. Most banks did not pass it through. A 42-year-old IT support specialist outside Indianapolis, making $66,000 a year, keeps an emergency fund of about $12,000 in a checking account at a national bank. That account pays 0.01% interest, that is $1.20 a year, at a high-yield savings account paying 4.00%. The same $12,000 would generate $480 a year. This person is not making a mistake rooted in ignorance. They set up the account in 2019, direct deposit goes there, and no one at the bank has ever mentioned the gap. Every institution holding those deposits has a structural incentive to keep that gap invisible. They earn the federal funds rate on that money overnight. The depositor earns $1.20. By any standard measure, this is a person doing what the system told them to do. The system did not mention the spread it keeps. The second line runs through credit card debt. Total revolving credit card balances reached $1.28 trillion in the fourth quarter of 2025, according to the Federal Reserve Bank of New York's Household Debt and Credit Report. That is a record. The average household credit card balance is approximately $11,500 per WalletHub's analysis of Federal Reserve data. A record 111 million Americans are not paying their credit card bills in full each month, according to a March 2026 report from the Century Foundation, as covered by MarketWatch and CBS News. The average credit card APR sits between 20 and 25%, depending on the source and the methodology. Forbes Advisor reports 25.30% as of mid-April 2026. Card Ratings reports 23.44% for the first quarter of 2026. The Federal Reserve's own G.19 release shows the commercial bank interest rate on credit card plans at 21% as of February 2026, trending near historic highs. Here is the mechanical relationship. Credit card APRs are generally calculated as the prime rate plus a margin. The prime rate is the federal funds rate plus 3 percentage points. When the Fed holds at 3.50 to 3.75%, the prime rate holds at roughly 6.50 to 6.75%. The margin that issuers add on top has widened over the past decade. And this is all public data, public math, not personal advice for anyone's specific situation. But the numbers trace a path that is difficult to look away from. Start with a household carrying the average balance of $11,500 at an APR of 23%. Minimum payments on most cards are calculated as the greater of a flat amount, or roughly 1 to 2% of the balance plus accrued interest. On this balance, a typical minimum payment starts around $265 to $335 a month, depending on the issuer's formula. If this household makes only the minimum payment every month and adds no new charges, the payoff timeline stretches past 15 years under most calculation methods. The total interest paid over that period can exceed the original balance. The household pays back more in interest than they originally owed. $1.28 trillion with a T. Every month the Fed holds, that APR does not move. Every month the cardholder makes the minimum, the balance barely moves either. The rate holds, the debt holds, the interest accrues. Now the third line, the 30-year fixed mortgage rate. March 2026. Unlike the savings rate and the credit card AP, the mortgage rate does not track the federal funds rate directly. It tracks the 10-year Treasury yield, investor demand for mortgage-backed securities, and the risk premium lenders add on top. As of mid-April 2026, the average 30-year fixed mortgage rate is approximately 6.24 to 6.38%, according to Bankrate's national survey and historical rate data. That is down from the 2025 average of 6.66%. The Fed held rates steady twice in a row. Mortgage rates came down anyway. This is the part that most rate coverage gets wrong. The Fed does not set your mortgage rate, the bond market does. And the bond market right now is pricing in the expectation that the Fed will eventually cut, that inflation will eventually cool, and that economic growth may slow. Treasury yields have responded to geopolitical risk, to the conflict in the Middle East that drove oil prices up more than 50% from pre-war levels, according to Reuters, and to the resulting flight to safety that pushed bond prices up and yields down. But here is the part that should break your brain. The same geopolitical event that is helping mortgage rates come down is the same event that pushed the Fed to discuss rate increases in the March minutes. The war that is lowering your borrowing cost on a house is raising the probability that your savings rate stays elevated for longer, and that your credit card rate stays punishing for longer, and that the Fed does not cut at all this year. One event, 3 instruments, 3 different directions. A couple in their early 30s, both teachers. Combined income around $96,000, renting in a mid-sized city in North Carolina. Have been saving for a down payment for 3 years. They have $38,000 in a high-yield savings account, earning 4.10%. They are watching mortgage rates. At 6.25% on a $350,000 house with 10% down, the monthly principal and interest payment is approximately $1,940. At 5.50%, the same loan drops to about $1,790 a month. That is $150 a month, $1,800 a year. $54,000 over 30 years. They could wait for lower rates. Every month they wait, the savings account pays them about $130 in interest. But every month they wait, rents in their area are running $1,650. The $130 in interest does not offset the $1,650 in rent, and there is no guarantee the rate goes to 5.5. Oh, the March minute suggests some officials wanted to raise rates, not lower them. The couple made the reasonable decision to keep waiting. They followed the conventional logic. That logic assumed the next move would be a cut. The March minutes introduced the possibility that it might not be. This is the same decision most people in their position would have made. Every part of it was reasonable. The total cost, if rates do not come down for another 18 months, is somewhere between $30,000 and $50,000 in additional rent paid while waiting, partially offset by interest earned, but not enough to close the gap. 3 numbers define April 2026 for the average American household. 0.39%, the national average savings rate, per the FDIC. The floor that most people stand on without knowing a higher floor exists 4 clicks away. 23%, the approximate average credit card AP, per the Federal Reserve, SG.19 and multiple industry surveys. The rate that turns an $11,500 balance into a multi-decade repayment if left on minimum. 6.25%, the approximate average 30-year fixed mortgage rate per Bankrate. Down from last year, but still roughly double what was available in 2021. The tide is high. All 3 boats are floating, but 2 of them are taking on water. Somewhere tonight, in a kitchen in a mid-size American city. Someone is looking at a credit card statement on a phone screen. The minimum payment is circled. The APR is listed in smaller font on the second page. The total interest charged this billing cycle is a number they have seen before, but never added up across 12 months. They are not going to call the bank. They are not going to move their savings. They are not going to recalculate their mortgage timeline, not tonight. And the Federal Reserve is not going to cut rates on the 29th of April. The next FOMC meeting is 13 days away. The question facing 330 million Americans is not what the Fed will do. It is which of the three lines, savings, debt, or housing, they are most exposed to, and whether they have looked at the number recently enough to know